Hello to all our viewers out there. I'm Tom Glatt with Glatt Consulting Group, and thanks for tuning in to our latest Insights podcast or episode, whatever you want to call this thing. This particular episode is all about dissecting crucial trends from the most recent credit union HealthScore report that my company, Glatt Consulting Group, provides for free to the credit union community. In this brief update, I'll shed light on what the latest score patterns portend for the future of credit unions, so prepare to dive into the health of asset growth, operating expenses, loan quality, and more. All vital indicators that reflect the pulse of the credit union community. Okay, let's look at this real quick as we get into it. What is the health score? Not everybody that's watching this may be familiar, so real briefly, let's get into that. The health score is essentially, I guess you'd call it a report card for individual credit unions and for the industry as a whole. It helps lots of people, us, industry leaders, anyone interested in credit unions. It helps more easily see and contextualize industry and individual credit union trends and issues. Contextualize. What do I mean by that? Hey, if we're going up in some numbers, are other people doing the same? Are they going down? Do we need to pay attention to the world in different ways? That's what I mean by contextualizing. How do we determine the health score? That's a good question. We first assess individual credit union performance. What I mean by that is every single credit union that's chartered by, or rather federally insured in the United States. We assess individual performance by assigning a score. I'll get into the range in a second, but we assign a score for each of 17 different ratios. They're on the screen here, and they include capital ratios, net worth, solvency. Solvency is not one that's commonly talked about, but it's if we were to liquidate everything in our estimation, would we have enough money to pay back all our creditors and also make our members whole when we think about the deposit relationships they have with us. We move into our income metrics, return on assets, operating expenses to assets. Those are, one is how much are we making income relative to our assets, and the other is how much are we spending relative to our assets. The next one we see up here, number 5, is efficiency. I love that one. It's how much are we spending to make a dollar. It's great to look at income to assets and operating expenses to assets, but assets, as we'll see, can fluctuate in weird ways, but we can always find this kind of solace in looking at, are we balancing out income to expenses in proper ways? After efficiency, we're looking at 6 and 7 and 8. Those 3 metrics relate to credit quality. One is delinquent loans to total loans. So what's the percentage of loans that are paying late? We're looking at that ratio. We haven't charged them off or written them off. We're hoping that they'll pay back, but they're not paying right now. That's what a delinquent loan is. Net charge-offs to average loans is when we've actually written that loan off. The Texas ratio, that one is a credit quality metric, but I would also call that maybe one of those capital metrics. And the reason I say that is because the Texas ratio is looking at, in effect, the long-term delinquencies we have. These are loans that are likely to become charge-offs, plus other real estate owned. This would be things that we foreclosed on, divided by that capital that we've set aside. That's why I say it's kind of like a capital ratio of sorts, or a buffer of risk ratio. But it's the capital plus our allowance for loan loss account. That's how much we've set aside to cover loan losses. And so we're looking at that as a bit of a loan loss coverage ratio. Incidentally, it's called the Texas ratio because it was created in the 80s as a means to evaluate rising risk in savings and loans. And a lot of that savings and loan crisis, if you remember that from your banking history, was happening in the state of Texas. So they called it the Texas ratio. We then move into liquidity metrics here. We've got 9, 10, and 11. 9 is cash and short-term investments to assets. That's what real short-term liquid assets we have, either to give money to somebody who comes in and wants to take it out of their account, or give money to someone who's coming in asking for a loan. Regular shares to total shares and borrowings. That's a metric of our what we'll call our core financial relationship with our members. Regular shares, if you're not familiar with credit union lingo, that simply means a savings account. This is sort of our basic plain savings account. And for years in credit unions, a regular share account has been sort of the sticky account that keeps people in the organization. It's the kind of the account you can look at and know that money is just, it's kind of relationship defined. It's not based on rate. It's not based on features or functions. It's just money that sits because of the relationship. Then we've got one more in our liquidity metrics, total loans to total assets. That's how much we have loans in outstanding relative to the asset base. Then we get into what I would call our member relationship metrics. One is loans in dollar terms per member, how much each member has in theory in loans outstanding. Deposits per member is looking at a similar kind of thing, but on the deposit side. And the third one there is what percentage of the membership base, so in credit unions, members mean the customer base, if you want to use that language, but our membership base, what percentage of our membership base actually borrow from us? And that number we want to be relatively stable and healthy because we're credit unions, we're financial institutions, and predominantly the highest and greatest source of income is loans, interest income on loans. So that borrowers per member is a good metric for relationship dynamics. And then finally, we have three growth metrics: asset growth, loan growth, and the last one, there's membership growth. Now, as I said, we have a scorecard, right? We're grading performance. So with a grade comes a score of some kind or a metric. So our scoring is simply based on a 10-point scale, with 10 generally indicating high performance and health, 0 indicating low performance or health, generally speaking, and 5 generally indicating performance that's average by industry historical standards. 5 actually is average by industry historical standards. So the 0 and the 10 generally indicating high performance or low performance. I'm saying generally because in the banking industry, you sometimes don't want high scores or low scores. Sometimes you do want low scores in certain areas, depending on your balance sheet strategy and environmental influences. So I'll give you a quick example. Maybe you've got a capital problem. Well, the net worth ratio, we use that. So net worth is your equity divided by your assets. And you feed equity with income, and assets are kind of assets, right? We take deposits in, that's a liability. The liability becomes cash, and that then becomes an asset, right? It's a balance sheet. And we want to do something with that cash. We want to put it to work. We can make a loan with it. We'll get income on that loan, or perhaps we make an investment with that money if we can't loan it out. If we have low net worth and we're getting to a point where the regulator is a little worried about it, then and we don't have the capacity to make lots of money real quickly, we might have to slow asset growth or even shrink in assets to strengthen net worth. So we want a lower score in asset growth, consequently, to drive a higher score in net worth. That's what I mean by saying, generally speaking, 10 is good, right? Generally speaking, we're pushing higher in 10. We want good, strong numbers in all the categories, but a lot of what we're shooting for and really managing to is dependent on a number of circumstances, including strategy and the environment. By the way, the 17 ratios, which we call HealthScore components, were selected for their strong relationship to sound credit union performance overall. And by sound, I mean that it's credit unions that were able to survive, thrive, even in circumstances where the times were challenging. And we determine which 17 ratios to include following what I would say is a statistically proper correlation study. Granted, it was a little over 10 years ago, but at the time, all these 17 metrics were proven to be the ones to watch. So back to our score, how do we get this score calculated? Well, we look at scores. We score each of the 17 ratios for individual credit unions, and these component scores are then averaged up to determine a given credit union's overall health score. That's right, we've got scores for every single credit union for those 17 metrics and overall. So there's a health score for every single credit union, and then we continue to kind of roll that up. Scores for the industry are calculated by averaging all the individual credit union scores, both for the components and then for the aggregate overarching industry health score. We're going to get to that. Before I get to that latest update, if you're not a current HealthScore subscriber, you can download your own copy of our latest score report on our website at glattconsulting.com HealthScore. You can see it right there on the screen. And if you're a credit union leader, which includes staff, board members, committee members, and the like, people who volunteer work for the credit union, you can subscribe to get a more detailed and custom report that includes the scores for your credit union in addition to the summary data I'm sharing here. That's for credit union volunteers and people. If you're a regular consumer and you're curious about the industry as a whole, you can download our industry report. So what's the industry score for Q4 2023? That's the latest date that we have information for all credit unions. The score is 6.048. The good news here is that the score is above the benchmark 5, right? But we're working above average here in the credit union community. However, The score is also a 2.58% decrease year over year. All right, so that means that as compared to 2022, that 6.048 is lower. So we're less healthy, if you want to look at it that way, than we were the year before. This is also the lowest score that we've had since COVID kind of restricted or slowed loan growth and income for the credit union community. And also, it's the third straight quarter showing a year-over-year decline. So there's a lot going on here. We've got a good score, but it seems like there's a little bit of turmoil underneath. There's a lot to unpack, so let's get into it. And we'll start with asset growth. Weakness in the asset growth score. First off, the chart you're looking at, and you'll look at similar charts as we go through some of the data. We're not going to look at all metrics. We're going to look at some that I'm particularly interested in this quarter. But these are year-over-year percent change charts. So this allows us to understand what kind of trends we're looking at in the component. So there's a zero line there. Anytime you see the chart line above zero, that means improving scores. Anytime you see it below zero, that means weakening scores. And this is just a way for us to understand, like I said, the trends. So weakness in the score, in the asset growth score, continued in Q4. You can see that for the last few metrics, a few data points there, it's below that zero line. Matter of fact, Q4 was the 11th straight quarter of decline. Worse than that, the asset growth score, which is not in the chart, but you see it on the left-hand side of my text there, that score of 1.89, it's by far the lowest we've ever seen for the component. What's hampering asset growth? Number of things, right? We still got that weird dynamic from all the stimulus money that came in to kind of prop everyone up for COVID. But we also have things like tightening underwriting standards. We've had liquidity challenge in the credit union and the banking space. And one way to kind of deal with that is to tighten up to make it harder to get loans. So we kind of slow the outflow of funds to fund loans. Right? So that's one way to do it, is tightening standards. And I'll come back to that in a little bit. We also have inflation, which is affecting how much people are spending. So more money is going out than coming in. We have interest rates and rate competition. So other entities might be charging more rates. We've got yield chasers out there as far as institutions go, attracting yield chasing members, and they might be taking their money out. These are just to name a few of the challenges. So that's what's going on there in asset growth. We see that declining year over year change in our overarching health score. One of the factors is this particular component right here. And man, what a wild chart this is. There's always some volatility in asset growth, right? We've got, fourth quarter, people start spending money for the holidays. In the first quarter, they start trying to claw that back and save some money. Maybe you start getting bonuses and whatnot. Money comes in, tax refunds come in. So there's always going to be some noise in the asset growth data. But you can see, even with the Great Recession, we never saw anything like that big, huge. It looks like Half Dome at Yosemite on the right-hand side there, followed by, the worst black diamond ski slope you can imagine. So we saw a lot of asset growth coming in, and then it's been a little bit tepid, to say the least, since then. All right. Speaking of asset growth trends and inflation, both of those things conspired to negatively impact our operating expense score. And you see that here, again, year-over-year percent change. It continued its own declining trend. So the score itself is still above 5. We got a score of 5.66 at quarters in. And I guess what I would say is it was as high as 6.46 in 2022. So we've seen over time a 12% decline in a little over a year overall. I don't think an asset growth turnaround seems likely, meaning that our assets will grow so much that it'll make our operating expenses seem lower. Nor do I think that we're going to see expenses cooling, right? I mean, all those things that tend to be pushing on us, healthcare costs, wage and salary pressures, still higher cost. We're not seeing deflation, so we're at least plateauing, if not still climbing, and just costs to run our offices and whatnot. So I really expect the score to at least moderate to closer to 5, if not a little bit below. And that means that we might see some continuing decline in the operating expense score. By the way, you can kind of see it's a relatively stable metric. Credit unions don't all of a sudden go on a tear spending money or cutting expenses. But we see a couple of weird things in here where the data just looks different than kind of the average. One is back there where we see that it looks like an EKG chart. You see that blip down, and then we see that climb right back up, almost 150% change in the score. What is that? Well, if you remember your credit union history, if you're a credit union person, then you'll remember that in the Great Recession, we had a number of corporate credit unions struggling and a couple that failed. And when a financial institution fails, you cover those costs with something called your share insurance or your deposit insurance fund. For banks, if you're insured by the Federal Deposit Insurance Corporation, the FDIC, that fund covers bank failures, bank costs, and the like. Credit unions have their own. It's called the National Credit Union Share Insurance Fund. So when there was turbulence in the credit union community and we had those corporate failures and some challenges with specific individual credit unions because of arguably management decisions that might not have been wise, but certainly Great Recession turmoil, then there were costs that the industry had to repay because of hits to the share insurance fund. So there are a couple things there. Credit unions had to stabilize the corporate credit union system and recapitalize that share insurance fund. And the reason we see that big drop in and then substantial increase there is because when the bill came due, if you will, credit unions were given a bill that said, pay this all at once. Hence that huge decline in operating expense that we saw right there a little before that 2010 dateline. And then you see it go way back up. Like our operating expense scores got better. We saw a positive change in the scores year over year. The score got better. That's because the agency, the NCUA, worked with Congress to allow for changes in how that had to be recapitalized, the share insurance fund, and that allowed credit unions to kind of spread that out over time to simplify all the things that were going on at that time. So there was that drop and that huge increase as things were charged and reversed, and then the costs thereafter kind of stabilized, for lack of a better word. And then we've got that blip here that's sort of between 2020 and 2022. Operating expenses, our scores went up. That doesn't mean that credit unions were spending less, although in many ways, I guess in some ways it does, because when we had COVID lockdowns, people weren't spending much of anything. But remember, we had all that asset growth, that prior chart I just showed you. So when we have that asset growth, that means that expenses relative to the assets are lower, and lower means higher scores for us, right? We're saying, hey, we're really managing our expenses well. Let's get higher scores. That's what was happening there. That's why you see that blip. All right, following declining trends, I would say also following our declining trends are our credit quality metrics here, delinquent loans and charge-offs. So I'm going to focus on those two. The delinquent loan score saw its 7th quarter of year-over-year decline, and charge-off its 6th. Now remember, all of our scores are 0 to 10, with 0 being bad, 10 being strong. When you look at the delinquency ratio, we think lower is better, less credit quality, less credit risk, credit quality issues. So we want a lower score. No, even for this in our score model, higher is better. So the delinquency score saw its 7th quarter of year-over-year decline and charge-off at 6. That means that delinquencies and charge-offs are increasing. More importantly than the trend itself, though, is the pace of decline in each of these two components. It's accelerating. Pardon me. It's accelerating for both the delinquency score and charge-off. Delinquencies. Okay, so we're back. I get choked up talking about delinquencies and charge-offs. It breaks my heart. I also needed some water. So like I was saying, more importantly than this year-over-year trend is the pace. So you can see that the angle of downward trajectory on both of those metrics is fairly steep, right? So the delinquent loans year-over-year change was down 7.64%. Charge-offs was 12.97%. That was in Q4. Going back to Q3, delinquencies dropped 6.13% and charge-offs 12.4%. So compare the two. Delinquencies in Q4, 7.64% decline. Prior to that, 6.13%. So the decline is getting bigger. that means that delinquencies and charge-offs, like I said, are getting worse. If we think about the score of 5 being average, I think we'll moderate to the 5. So you can see the scores here, 6.41, 6.43. We've got room to go till we get to 5. I think we're going to see continued declines in credit quality, continued declines in the charge-off and delinquency scores. Okay. Now, one other thing I'll mention about that is that, again, the scores of 6.41 and 6.43, they're still positive overall. They are above average. So I guess I would take that as a positive if we can stabilize, if there's no continuing economic challenges, global disharmony and disunity and strife goes away, then maybe we go back up. But that just seems unrealistic given everything that we're seeing. So again, I would plan for higher delinquencies and charge-offs. Regular shares. It's seeing a similar accelerating pace of decline. And again, when I say regular shares, I mean that metric that is the regular shares to total shares and borrowings. The fourth quarter saw a decline of 9.80% to a score of 5.43. And that's still above 5, like I just mentioned. Some of our other scores are. Delinquencies and charge-offs. But this is the lowest score for this particular component since 2011. And it's pretty big. Look at that change. It's interesting. This is kind of a side observation I'm making, a spot in the moment. I have notes in front of me that I'm trying to stay on track. But there was a lot of talk back in 2003, 4, 5, in that time frame, pre-Great Recession, where there was a great concern about the U.S. savings rate. People weren't saving much. They weren't putting money away in savings accounts and the like. And you started to see that change, right? The pace of decline in regular shares started to turn around there around the Great Recession, and we saw people starting to build strength in regular savings accounts, wealth growth and all of that good stuff. Well, that kind of has turned around here in a way, looking at this particular metric. So for credit unions, like I said kind of in the intro, regular shares is an indicator of a strong, sticky relationship. And I'm looking at this chart, and I think it begs the question, is the regular share account losing its place as a critical and sticky indicator of the strength of the member relationship? It's kind of that agnostic, rate insensitive pile of money that people put in because they know that we're safe and they know that we're going to be here and they know that they're always going to come back and do something with us in terms of a relationship. Are we losing that as an indicator of the relationship that we've got? I think we are, at least for a number of credit unions. But I don't think that should mean that credit unions kind of just become oblivious or ambivalent to it. I don't think you should let regular share balances and the people that own them kind of decamp to the competition. So what's the strategy here? All right, how do we make sure that core remains the core for the bulk of our members? Or if it doesn't, right? What's the product combination that allows us to cement and strengthen relationships if that regular share account is no longer the indicator of resilient relationships that it once was? All right, how about loan growth? It was pretty hot coming out of COVID. Look at that chart there. We see that 1/1/2020, it's below the line, below the zero line, and then it shoots back up there. It doesn't quite look like Half Dome in Yosemite. It looks more like, I don't know, a peak in the Rockies or something like that. Well, loan growth is now also underperforming, as you can see. That's gone below the zero line. Year-over-year decline is 31.76%. So look at that scale on the left-hand side. That's a huge decline. And our score is 4.62, so we're below 5 now. The drop in the component score, I think, is due to a couple of influences, predominantly. One is intentional tightening of underwriting standards to temper loan demand for liquidity purposes. Right? We had so much money coming in, there was too much liquidity, and then all of a sudden that loan demand picked up, as we see here. Creditors are putting loans on the books left and right, and then the rates started to go up, and we had these, for some credit unions, longer-term loans, and all of a sudden members wanting to either put their money in something long-term in the credit union or, more drastically, take it to some other place. But we still had that sort of push and pull. The loan demand was still there, even as we were seeing rates begin to change. So some credit unions got into intentional tightening of underwriting standards, as I mentioned, to temper that loan demand for liquidity purposes. And the other thing we see here is interest rates eventually have taken hold and have slowed some demand for loans. Now, with regard to underwriting standards, we kind of look at them and go, what loans are we talking about here? I think then we need to go to another source of data. I'm going to show you a couple of things from the Federal Reserve Senior Loan Officer Survey, the most recent results of which came out this January. Here's what the most recent loan officer survey noted. Tighter standards and weaker demand for C&I loans to firms of all sizes over the fourth quarter. Now, not a lot of credit unions do commercial and industrial C&I loans, but if you do, then those are standard. Those are tightening up. Institutions that are offering those kinds of loans are tightening up the underwriting standards, meaning making it harder to get a loan. On top of that, they're also suggesting there's weaker demand. Second bullet point, tighter standards and weaker demand for commercial real estate loan categories. And a lot of credit unions that are in business lending predominantly focus on commercial real estate, with the idea being it's a more secure kind of loan relative to commercial and industrial. And it's manageable because many credit unions that are doing commercial real estate also do residential real estate. So it's something that we kind of understand in a way. But even that, tightening standards, weaker demand. Now look at this, residential real estate, tightening across all categories and weakening demand. As we see, weakened demand for all residential real estate loan categories. Tightening standards, weaker demand for home equity lines of credit. And how about credit cards, autos, and other consumer loans? Yep, you guessed it, tighter standards and weaker demand on balance for those products. So when I look at that loan chart, going back here, I'm not sure we're going to see loan growth turn around where we've got scores that are above zero. We're seeing ever increasing loan demand, at least not for the foreseeable future. But the thing to pay attention to is when these standards start to change, right? If they start to change, that's the credit tap reopening, if you will. And you don't want to be the last one opening up the tap because you'll lose out on some loan opportunity. All right, how about credit union income? I don't have a chart here. I've just got some text and I wanted to point out to you. We've got loan growth pressures, right? We got return on asset scores and efficiency. If loan growth is our primary source of revenue and we've got pressure there, what does it mean? Well, hey, actually return on assets and efficiency scores are pretty good. They've continued positive and upward momentum. The return on asset score is 5.66, a 10.08% year-over-year gain over 2022, and efficiency is at 6.01. That's a 13.4% gain. So we've got good numbers on those two income components. Remember, we saw operating expenses increase there, driven by lower assets, and that's similar issue we're seeing here with return on assets, right? That improving score was certainly aided by asset growth trends in a fashion similar to the operating expense score. So I think the efficiency score adds helpful context, right? Assets are messing with our understanding of return on assets, but when we look at it in terms of expenses, credit unions are making more per dollar spent. I like that. Now, you might have this on your mind. What about those articles that I've seen lately? One headline I noted a few minutes ago as I was getting ready for this, is that one suggests that 25% of credit unions lost money. Now, they kind of cherry-picked the way the data flowed, right? They weren't looking at the whole year. But regardless, many headlines are reporting that sizable numbers of credit unions lost money, or credit unions lost money a lot in Q4. So it's either looking at the number of credit unions lost money, or it's looking at the volume of money that was lost. But what's the real story? I'm telling you, we've got ROA and efficiency score strength, and you're hearing maybe there's some weaknesses. Well, here's the way I look at it. This is my perspective. 87% of credit unions had a positive ROA as of Q4. Only 621 credit unions out of, 4,702 had a loss. So what causes that consternation then and drives a lot of the hand-wringing we're seeing in some of these news headlines? Well, in the mix of the 621 are some rather large credit unions. When you look at the size of the losses in the credit union community in total relative to past experience, it's a pretty big number. It's unusual. So people are paying attention to the handful of credit unions that have lost money because of how much they've lost, relatively speaking. But the important thing to remember is that the credit union community isn't one monolithic enterprise, right? It's 4,702 individual institutions, and 4,081 of those credit unions don't have a net loss when you look at the totality of their performance in 2023. My final observation of note before we look at score leaders is the ever-increasing loans per member score. And I haven't paid much attention to this one over the years. It's one of those component scores that just kind of, it's there, right? We don't see a lot of changes. But let's look at it this time because there's a telling trend. But I want to point out that the chart that we're looking at is not a year-over-year percent change chart like we were looking at for the prior few slides. This one is actually charting the score itself. So 2023 saw the highest ever, I mean, you can see it in the chart, the highest ever score for the component, with the fourth quarter the highest of the high at a score of 7.54. On the one hand, you just look at this as a trend. It makes sense. We've got rising cost of household assets. Cars were more expensive, certainly more expensive during COVID, right? You can see that little, almost a flat line there in that 2020 timeframe before those numbers started going back up again. Right, there was very little buying, very little borrowing, but then it took off. So we've seen, just in general over the course of the entirety of the chart, rising costs of household assets, cars, homes, and the like. You combine that with the fact that more credit unions than ever are also doing mortgage loans, those residential real estate loans we just talked about. And there are also more credit unions getting into commercial or business lending, in particular, like I said, commercial real estate, and both those categories, mortgages and commercial real estate. Those are high dollar loan categories. So you look at inflationary effects on the costs of assets and also getting into high dollar loan categories, it stands to reason we're going to see overarching long-term growth in the loans per member score. But consider it in the context of membership growth. That's what I want to point out here. No big deal if we see loans per member as a dollar figure going up. And what it means for us is we're going to have to recalculate or re-benchmark our score, right? Because we're not going to go down in the scores there. But membership growth in the industry is rather poor, right? We're in the twos in our scores. And it's consistently a challenge for growth in membership, which is funny now. You'd think we'd be growing better than we were years ago. But credit unions years ago often were growing because the relationships they had with core sponsors were solid and the sponsors themselves were growing. We don't have that dynamic for many credit unions anymore. I think that means that we've got a pending problem we want to pay attention to. Slow membership growth could or certainly might mean, or probably will mean, limited upside loan growth opportunities for many credit unions. In other words, as the current well of loan opportunity exhausts itself, there may be no one left to drive or sustain new growth. So, if we don't pay attention to the next generation and drive the membership growth to higher levels and better performance, then this number is going to crater because those loans will pay off and we won't have members around to fill the void. And you don't want to wait until that moment in order to fix the problem. All right, so let's move on to our final bit of HealthScore update. And that is our leaders list, one of my favorite parts here, because it's always interesting to see who pops at the top. And for this quarter, we've got Port Washington Federal Credit Union. They've got the top spot with a score of 8.941. They're in Port Washington, New York, $67.8 million in assets, and they serve over 3,000 members. Now, I mean, it's nice to see billion-dollar plus credit unions up there in the top, and we got one I'll point out. But I also like seeing credit unions that are relatively small. I mean, well, relatively. This is a small institution, $67 million in assets. It is no B of A, I'll tell you that. Somebody probably has an account that's got $67 million in it and at B of A, an individual probably. But, regardless, this credit union, they occupy the top spot now. I took a look at their numbers. They are pretty solid all the time. They do pretty well. I reached out to their CEO. Hopefully I'll hear back at some point because I'm curious what they attribute their consistency to, consistent success. And I did check them out online too. They're a little smaller credit union. They're a little old school in their marketing and messaging. Some of that stuff looks like, retro 2003, 4, something like that. But hey, whatever they're doing works. So who's to say you've got to look like everybody else in your marketing and messaging? If what you're doing resonates and you kind of build and strengthen and sustain good, strong relationships with members, who cares what anybody else is doing? So good for you guys, Port Washington. Nice to see you doing well. The look that I'm giving you now is actually from our industry report. This is the one that's downloadable on our website. We have here, I wanted to point out Lynn Fireman's, they're number 2. They've got a score of 8.618. They're out of Lynn, Massachusetts there, and they're a tidy 18.8 million, a little smaller than Port Washington with 1,519 members. Lynn is old school in a different way. They're old school in their marketing, but they're old school in the fact that they're primarily focused on a core type of member. They're focused on local area fire departments. And I can tell you, firefighters make good members. I know a few firefighters, actually, friends of mine. They're good people, right? And obviously they support credit unions to good performance. And I'll point out another one here. We've got Knoxville firefighters. We've got actually 3 firefighter-oriented or adjacent credit unions in our top 20 list. So here's the next one, Lynn, out of Knoxville firefighters. In addition to Lynn, Knoxville firefighters out of Tennessee. They're in the 5th spot. You can see there, let's see, let me lean in, Knoxville, 8.471, that's their score. 1 branch, 5 employees, 1,600 members. You know, they're serving them well. And there's another one that I don't have here for you to look at. It's called Responders Emergency Services Credit Union. They serve firefighters among other first responders. Man, that's a long name. Responders Emergency Services Credit Union. But the acronym is great. It's called RESCUE, RESCU, right? I love it. RESCUE is the acronym for this credit union. Get it? RESCUE, first responders. I love it. All right, the last one I'll make note of before we close out here is Sikorsky Financial. They're out of Stratford, Connecticut. They are the highest scoring credit union with more than $1 billion in assets, actually at $1.2 billion. They have 66,000 members with a score of 8.412. Good for y'all. Sikorsky, they're in Connecticut. All right. These are only a few of the many interesting credit unions on our leaders list. It's fascinating to dive in and explore how they present themselves to the marketplace, which you can do yourself if you get your own copy of our industry report via the website at glattconsulting.com/HealthScore. In that report, you can see the full top 20, which includes quite the array of diverse credit unions. You won't see the charts that I shared with you. Better yet, you'll see the actual year-over-year percent change for the last, few years for each of the components, the HealthScore and the raw scores themselves. So check that out. You can find it again here at glattconsulting.com. So that's it for this Insights Brief. If you have questions about credit union health and performance, let us know. We can be reached at hello@glattconsulting.com. Hello@glattconsulting.com right on the screen, or fill out the Contact Us form on the Glatt Consulting website. Once again, I'm Tom Glatt with Glatt Consulting, and thanks for watching.